This is Daniela Camboni for Kitco News, and you're watching a special edition of Reset. Stay tuned. Vince, so nice for you to join me today.
Hello, nice to see you again as well, Daniela.
So Vince, back in December, analysts I spoke to had said that the gold bull market was over. They expected it to rally much more. My question to you today then is, are the fundamentals for gold still there?
Ignoring technicals for a moment, the fundamentals are still there. Nothing has changed. There's been no resolution out of Europe. In fact, there's more uncertainty in the Middle East. And on the U.S. side, the markets seem to be gearing up for a QE3, whether it's justified or not. So the fundamentals are all there. Nothing has changed. The technicals are very constructive in the last, say 5 days. The market looks poised to do well again. There is a missing link, though. People have been speaking with you, and retail customers have been saying, if the fundamentals are there, why is the market doing what it's doing, especially in the big sell-off in December? And there is one variable that we think is overlooked, and that is the effect that margin requirements have on futures markets. And we've been looking into that recently and found that they have a very pronounced dampening effect on the precious metals, more so than other markets.
So would you say this is the missing piece of the puzzle as to why perhaps gold has not performed as well as it should have?
I'm sure there are other missing pieces. The more I know, the less I know. But this piece, we think, is grossly neglected simply because when gold, silver, or platinum have parabolic moves higher, the CME, other exchanges would do it as well, will raise margin requirements. So an example of that would be if you had bought a contract in gold, let's say you're a hedge fund, not an individual, in the beginning of 2011, your margin requirement for that contract would be $4,500. And hedge funds base their rates of return on the capital they invest, just like individuals do. But by the end of the year, your margin requirement would have been approximately $8,500. We're talking about a 90% change in the amount of capital you need to carry the position. That destroys their returns, and it makes them a herd of sheep run out of a market at the same time. And you'll note that when margin requirements go up in precious metals, the markets have precipitous sell-offs. And this leaves retail investors saying, what changed? Nothing changed. Just over-leveraged speculators gotten out. The fundamentals are still there. And we believe these are buying opportunities for the metals if you can stomach the longer-term volatility, the shorter-term volatility for a longer-term gain.
So Vince, let's just re-break down those two key figures for our viewers again. The gold price change that we saw in 2011, the percentage change, and margin hike changes that we saw in 2011, again, percentage changes.
Gold's change in price over the year is for 2011 was 9%. So year over year, gold appreciated 9%. The margin hikes for gold, however, increased 88% for 2011. So if you were bullish on gold and you put $4,500 up to carry your gold contract, even if you were in the money, you had to put up more money. So there were opportunities that you had to miss out on.
So Vince, how are investors supposed to be making money?
Well, if you're playing the futures market and you're an investor or a trader, the most important thing is, and it's probably almost trite, everyone says it, leverage is not your friend when you're playing the futures markets. And by that I mean, you should use leverage, but you should know what your bankroll is. No different than someone sitting at a poker table or a blackjack table knowing, hey, should I split aces? Well, how much money do you have and what's the dealer showing? You have to know how much money you can commit to a trade. If you're not sure of that metric, then you should just keep it simple and you should just be owning physical bullion.
So let's look at the other commodities, Vince.
Sure, we did a workup on silver. We'll be looking at other commodities as well, but In silver, investors lost 13% had they bought the commodity in January and held it for the whole year. But their margin requirements went up an astounding 138%. That's incredible when you think about the amount of money that you're asked to keep committing to a trade when you thought you were fully committed using appropriate leverage as per the exchange's requirements. And it certainly has a dampening effect on the markets. If you look at an outside market, a non-precious metals market, the S&P, for example, the antithesis of precious metals, the stock market, the S&P 500 was up 0.38% last year, but its margin requirements were down 11% last year. Bottom line here is speculators will get into a market with lowered margin requirements, and they will run for the hills in a market with raised margin requirements. And the problem for investors is, or investors in futures is, they have to have enough dry gunpowder to put up to stomach these margin calls, or they'll get blown out of their positions. It's a very bad environment for retail investors when this sort of thing happens.
So how does someone safeguard themselves in this situation, Vince?
The safeguard for a retail investor would be knowing your bankroll, managing your VAR if you're a CFO or risk manager, going to the blackjack table and knowing how much money you're willing to put up or / lose. So that means, hey, I'm going to buy X amount of silver or X amount of gold, and I only need $4,000 to put up. I'm prepared to put up another $20,000 to carry this position, even if I'm not losing. If you don't want to do all that math, the simple, clear-cut answer is avoid the leverage and take physical delivery in whatever you can afford.
All right, Vince, thank you so much. It was a heavy topic today, but I think you broke it down for our viewers, and it's much appreciated. Thank you so much.
Thank you. Have a great week.
And thank you for watching. You can email me, as always, at newsfeedback@kitco.com. For Kitco News, I'm Daniela Kumbo.